Market corrections are often misunderstood. To many investors, they feel like failure, panic, or the beginning of a financial crisis. But in reality, corrections are a normal and even necessary part of how markets grow over time. If you study history closely, you will notice a pattern. Every strong long-term market trend is built on top of multiple corrections, pullbacks, and periods of fear. And instead of destroying wealth, these phases often reshape it, transfer it, and ultimately create some of the best long-term opportunities for disciplined investors to understand what a market correction can teach you about building wealth. You first need to understand what it actually is. A correction is typically defined as a decline of around 10% or more from a recent market high. It is not a crash, and it is not necessarily a sign of economic collapse. It is more like a reset of expectations. Prices rise too fast, investors become overly optimistic, and eventually the market cools down to a more realistic level. This cooling process is uncomfortable, but it is also healthy. It removes excess speculation and brings valuations back to more reasonable levels. One of the most important lessons corrections teach you is emotional control. Most people lose money not because they pick the wrong assets, but because they react emotionally at the wrong time. When markets fall, fear spreads quickly. People start imagining worst-case scenarios, and many investors sell at a loss just to feel safe again. However, long-term wealth is usually built by those who can stay calm during these periods. Corrections test your patience more than your intelligence. If you can learn to stay disciplined when others are panicking, you automatically put yourself ahead of the majority of market participants. Another powerful lesson is that volatility is not the enemy of wealth building, it is actually a part of it. Many beginners think that the goal of investing is to avoid losses completely. But in reality, higher returns almost always come with some level of volatility. If prices never move down, there would be no opportunity to buy assets at a discount. Corrections are what create those discounts. They allow long-term investors to accumulate quality assets at better prices, which increases future return potential. In simple terms, volatility is the price you pay for opportunity. Market corrections also teach the importance of time horizon. When you focus only on the short term, every drop feels like a disaster. But when you zoom out and think in years or decades, corrections start to look much smaller and less threatening. Historically, markets have recovered from every correction and gone on to reach new highs. This does not mean recovery is immediate, but it does show a long-term pattern of growth. Investors who understand this are less likely to panic and more likely to see downturns as part of a bigger journey rather than the end of it. Another key insight is the concept of buying when others are fearful. During corrections, sentiment often turns negative. News headlines become pessimistic, social media is filled with worry, and even experienced investors start doubting themselves. But this is often the environment where the best long-term opportunities are created. When prices fall due to fear rather than fundamentals, strong assets can become undervalued. Investors who have prepared cash, patience, and a clear strategy can take advantage of these moments. This does not mean blindly buying every dip, but rather selectively investing in quality during periods of weakness. Corrections also highlight the importance of diversification and risk management. If your entire financial future depends on one asset or one sector, a correction can feel devastating. But a well-diversified portfolio spreads risk across different areas, reducing the impact of any single downturn. This does not eliminate volatility, but it makes it more manageable. Wealth building is not just about maximizing returns, it is also about surviving long enough to benefit from long-term growth. Diversification helps ensure that temporary setbacks do not permanently damage your financial progress. Another lesson from corrections is that leverage can amplify both gains and losses. During rising markets, borrowing to invest may seem attractive because everything is going up. But when a correction hits, leverage can quickly turn small declines into large losses. This is why disciplined investors are careful with borrowed money and margin. Wealth is not just about how much you can make in good times, but also about how well you can protect yourself in bad times. Corrections expose whether your strategy is built for long-term survival or short-term excitement. Market corrections also teach humility. No one can predict the market perfectly. Even professionals with decades of experience cannot consistently time every high and low. Corrections remind investors that uncertainty is always present. Instead of trying to control the market, successful investors focus on controlling their behavior, their risk, and their consistency. Accepting that you do not know everything actually makes you a better investor, because it encourages discipline over prediction. Perhaps one of the most valuable lessons is that wealth is built through consistency, not perfection. You do not need to avoid every correction to succeed. You simply need to stay invested, continue learning, and keep making rational decisions over time. Many of the biggest wealth-building journeys include multiple corrections, recessions, and periods of doubt. What separates successful investors from unsuccessful ones is not that they avoided these moments, but that they stayed the course through them. In the end, market corrections are not obstacles to wealth creation. They are part of the process. They test your emotions, improve your discipline, and create opportunities for long-term growth. If you can learn to view corrections not as threats, but as natural phases of the financial cycle, your entire approach to investing changes. Instead of fearing downturns, you begin to understand them. And once you understand them, you are no longer controlled by them. Building wealth is not about predicting the next rise. It is about surviving the next fall, staying consistent through uncertainty, and positioning yourself to benefit when confidence returns. Market corrections teach all of this if you are willing to listen. By spreading investments across different asset classes such as stocks, bonds, and other instruments, you reduce overall risk. Corrections remind investors why putting all your money into a single investment can be dangerous, and why a balanced portfolio is essential for long-term success. During every correction, there is a shift in mindset between short-term fear and long-term opportunity. Those who focus only on immediate losses often exit the market, locking in their losses. But those who recognize the temporary nature of these declines begin to see value where others see danger. This difference in perspective is what separates reactive investors from strategic wealth builders. Ultimately, the greatest lesson from market corrections is that wealth is not built in comfort, but in discipline under pressure. Every downturn is a reminder that markets move in cycles, not straight lines. And those who stay patient, informed, and consistent through each cycle are the ones who benefit the most when growth returns.